Today, we're going to be talking about few things I think everyone should kind of understand and see where they stand on this kind of a economic learning scale. Because fundamentally, the reason why we don't understand a lot of things that happens in the market is because uh, we haven't been exposed to the right kind of knowledge with respect to this. So let's contradict some of the common misbeliefs, and then we'll go into a bit more discussion around some of the big risks that we are seeing today. So number one, we hear from a lot of so-called experts that the UK government will run out of money, right? And that's the reason why there is a 20 billion um, black hole that they found, etc. Because of that, they will run out of money. Unfortunately, that is not true. Um, while the existence of that 20 billion black hole is has been confirmed in the news, etc., this is basically that this was certain tax revenue that was expected, did not happen, was not budgeted, and accordingly, there were expenditures that were planned which exceeded the tax revenue. That is what they called as a black hole. So it's not that the UK government will run out of money. It will never run out of money. It is not designed to run out of money, nor is any other government that that we can basically think about. The reason for that is if there is a if there is a situation, they can simply create more money. You and I cannot create that money, or not legally possible to create that money. Okay, so back in the days, we were told that um, tax is the way that governments um, generate revenue. No, that is simply not true. Governments will spend and get it back, right? So it is not that they are waiting for a paycheck from you, take a part of the paycheck as the tax, and then spend from that. Governments are going to spend first, and then there is a certain part that is kind of like covered through taxes. So the reason why I say spend first is because they can create that money. Because they can create that money, they will use it to uh, invest in various public services and create those public services so that it then generates, um, all of the, you know, money supply in the system. So through which you are able to run businesses, you're able to be self-employed, whatever, or you're able to buy property, etc., etc. And then through that, you generate certain income. Tax is essentially a method through which the government is trying to pump out excess liquidity out of the system. The third misconception that I want to crack today is governments have too much debt today. I see a lot of people writing, in fact, some of them are economists. I see some of them writing public debt to GDP ratio is too high. Yeah, it is high. So what? There are situations where, you know, public debt to GDP ratio could be on the higher side. These are basically economic cycles, and we understand these by looking at how the markets have reacted to these um, higher levels of debt. And accordingly, we also understand how the fiscal policy is working at any point in time. So governments can have a lot more debt than what we see today. So even if the UK government doubled its gilt issuance, it is still possible to tackle that, let's first understand it is not debt. And the first and most important aspect to understand here is it is not debt. Why do I say that? Because it is an opportunity for you to save with the government, right? So you could save in your savings account with the bank, and the bank gives you a certain interest rate. And that interest rate is, um, let's say, 5%, 5.5%, whatever, they're giving you a certain interest rate. The government is going to give you 4.25% to 4%, right? That is an absolutely risk-free interest rate because the government is behind it. And it is a risk-free deposit that you have made with the government. That is how a guilt really works. Guilt or government securities. In the US, you have the treasury bonds, etc. This is how this works. This is an opportunity uh, um, for you to basically to save with the government. You could you could either save directly with the government if there is an opportunity for you to buy these bonds. If you're big enough, then you can do that. Or otherwise, you can save through a mutual fund that invests into government securities. Pretty much that is doable for all of us. So with that, what I also then wanted to, clarify here is there a limit to how much? Yes, governments will set a certain limit in terms of how much debt can be acceptable at any point in time. The reason for that is it must be able to service that debt, meaning the interest payments for that, it should be able to service that at any point in time, given all of the other expenditure that is there. So based on that, governments will obviously set that. That does not mean it doesn't have the capability to issue more gilts, government securities, especially bonds, etc. What it means is at that point in time, that's the amount that um, the elected representatives have allocated at a certain point in time to repay that debt, service the debt. And what we also hear is um, the the markets are overheated. Stock markets are overheated. The reality is it is not. It is your tech stocks are overheated. That is the reality. Now, if you look at this is one of the biggest risks that we have today, right? Which I think, in all fairness, I don't read a lot about, and I don't see many publications talk about. The biggest risk to your investments today is the highly volatile and high return dependence on tech stocks, right? So if you look at the S&P 500, uh, the tech stocks and the biggest tech stocks, the Magnificent Seven, are responsible for most of the returns last few years. Take last 10 years, right? From about 2015, this changed, and you will see that there is absolutely no uh, point in investing in the 496 other stocks in the S&P 500. That is how it looks like because this overshadows everything else. And that to me is the biggest risk. So take Nvidia, for example. The drawdown on that stock can be 15%. It can hit your portfolio in one single day. Whatever returns that you got the last 1 year, it can hit that portfolio in one single day. And uh, that is a big risk because also because of the fact that from a size perspective, these tech company market caps are significantly higher than the 496 other companies that are on the S&P 500. take any other um, you know um, index, you will you will probably find that there are some smaller set of stocks which maybe overshadow everything else. Not to this extent. What this really calls for is the S&P 500 are really fair index. That's something to think about. But on top of this, what we could also look at is, can we pick a handful of stocks from the S&P 500 and invest in them? Doable. It's doable for anybody. And using the ecoeconomics thesis, we picked a set of stocks from the S&P 500, all of them index stocks, not necessarily uh, the Magnificent Seven, and we delivered 5 to 7% above the S&P 500. Is it doable for you? Doable for me? Doable for anybody? And how do you do that? I don't want to dictate one particular method and then say, here are the 10 steps you use. Then you basically get this result. That is a false assumption. That is a lie that many people tell you. So let me just explain this. You have an expert telling you that here is my 10-step method to do this particular thing. And then you follow that exact 10 steps, and you get the exact same result that the expert got. You will get that if that process is operation, because the operational processes tend to follow um, pretty much, all of the, most of the returns will, most of the output will, most of the results. Let's take it that most of the results will clump together at the mean. So if you followed that process and you execute exactly like this, then it will be pretty simple. It doesn't work for things like marketing. If somebody tells you a marketing template, this is how it works, do exactly this, and you will also find 10 people doing, yeah, I did this, I did this, I did this. Don't get it. It doesn't work in marketing, it doesn't work in sales, it doesn't work in investing. The reason is these processes tend to be fat-tailed distributions, meaning there will be a small number of big hitters and a large number of low hitters, right? So that is the nature of these processes, and you can't do anything about it. So if somebody tells you a sales system, follow exactly these 10 steps, and then you get the exact same result. You will get the exact same results if you went to the same customer as your expert with the same product as your expert. So if your expert sold, uh, a digital marketing suite, you sell the exact same thing to the exact same person, you'll get the exact same result. If you go to another person, an XYZ, with a different product, then it's not going to work, right? So similarly, with investing, this is basically a fat tail distribution. You can't determine and say, here are my 10 stocks and I invested in these 10 stocks, I get the exact same result. No, you will not get the exact same result. Timings are different. You might trade in a certain market versus another market. You might be looking at using an ISA structure, which means that you can't go long and short. You can only go long. There are a number of things that will impact your returns. And that is the reason why I say follow my books, understand the trends behind that. Once you understand the trends behind it, pick your own set of stocks. There are a number of people doing this. I've been doing this method since about 2018. I started writing about it in 2021, and I published my book early part of last year. I published my first book. The second book came out early part of this year, but it's been in place for over 6, 7 years. And since the book has been published, there are several people who are trying it out. On top of this, I can also tell you there are a number of people who have used these trends, identified stocks based on that, and based on this, since 2021 onwards, they have been they have been investing in these trends for quite some time, right? So, is that doable for you as an individual? Yeah, pretty much doable as an individual. Pretty much doable as a family office. Pretty much doable as an institution. Anybody can pretty much use this. I run a business which invests in these stocks, and then we use basically a global equity long short method. So if you qualify for this as a high net worth individual, then we can talk about investing in our fund, and our fund generates a certain higher return because of the fact that we are going global market and we are going long short, which is not something that as an individual you might be able to do. Now, we talked about some of the fundamentals with respect to economics and why understanding these things are very, very important to understanding the markets. And one other thing that I want to talk about is interest rates. There are interest rate decisions that are being made, uh, and basically the ECB is expected to make a interest rate decision on Thursday, September 11th. That is basically a interest rate decision that's kind of expected. So we're expecting 2.15%, but given where we stand, I think that is probably where we come. Now, monetary policy as such, though there is a lot of noise around it, I think it's a very ineffective policy instrument. The reason why I say that is when there is a certain interest rate decision, the way it transmits through the economy, and then by the time there is an actual impact, sometimes it is 3 quarters, 4 quarters, sometimes even more than that. What I've seen in the past is when interest rates were kept low, it did take all the way up to about 6 quarters for the real impact to show in the economy. And there are also some perverse incentives to monetary policy. And I think the best way to control inflation, so the stated objective of monetary policy from the Bank of England's perspective is controlling inflation. Every central bank has that responsibility, but it is an ineffective uh, tool on its own. It only works when there is a suitable fiscal policy in place. And the fiscal policy plays maybe 80% of the role, and the monetary policy just transmits it, right? So you cannot just depend. But unfortunately, what happens is a lot of the market sentiment and uh, the market commentary is driven by the monetary policy statement. And then we say, okay, fine, there's a monetary policy decision that's coming up. So because of that, the market can be volatile. It's okay, fine, cool down. The reality is, it is basically a ineffective instrument. And on top of it, it is something that depends on the fiscal policy. You haven't understood the fiscal policy enough, but you're only making assumptions on the basis of monetary policy. I'll give you an example of the perverse incentive that happened. So post um, 2008, right? Um, there was a prolonged low interest rate regime. While the intended, uh, you know, uh, policy was to stimulate the economy, it took over 2 years, nearly 2 years. I shouldn't say over 2 years, but nearly 2 years for that to be felt in the economy, really. Also because of the fact that the fiscal policy stance at that particular time and the bailout of the banks, etc., etc. There was also the quantitative easing program that was set up. So the quantitative easing program was sucking out excess liquidity. This was creating more liquidity, and then there was basically a constant process of, I can say, dig a hole and fill it up sort of a situation that we had. So what this did, the intentions were good, but then what this did was, because the interest rates are low, it created the incentives for riskier investment. And as a result of that, what we are seeing today over the last 15 years time frame, like let's take 2010 till today, we see an asset bubble that's basically building up. So what was intended as a good policy measure then became pretty much of a perverse incentive, and uh, riskier investments were being made. And on top of it, we had a situation where many, I can say, private equity firms, investment firms capitalized on that situation. Low cost of borrowing, which meant that they can, buy out companies with a lower cost of the debt. They can buy out companies, they can strip the assets, and they can profit from that. So what really happened to the public was the cost of our products and services started going up because of these actions. So the real impact of having a lower interest rate situation did not really materialize for the bloke on the road. And who was highly impacted out of this is if you were just coming out of college or uni, just coming out of uni, going into a graduate role, or um, taking up some early career sort of opportunities. This was a situation where higher levels of student debt and pretty much wage growth that was not growing enough also created the situation with lower savings rate. The interest rates being offered by banks was like 0.5%, 1% at best. So what is the point of saving? So what happens is younger people are more disadvantaged in this situation because the older generation already has certain levels of generational wealth, property, etc. But the younger generation is not able to get into the housing ladder, not able to save onto this. Basically, the wage growth has declined. So with that situation, where we are today, 15 years, 17 years really, but let's take 15 years really, is that the the asset prices have gone up, real estate very specifically, asset prices have gone up drastically, but the wage hasn't kept up with it. So as an example, I live here in Stanmore, and out here, if you basically look at it, you're talking of maybe somebody with 100K plus salary being able to afford a mortgage over here. So that's where we are. So 15 years back, this would have been, somebody with a 40K, 45K salary comfortably being able to afford a mortgage out here. Today, we are at, at about 100K plus. And even those 100K plus, there's a term called Henry that we're being told high earning, not rich yet. Right? That's sort of the perverse incentive that's being created as part of this. So with this, what we also have to remember is that there are basically two parts to this game. So if you were to invest in this sort of a situation today with all of the existing risks, I want to talk about few of the other risks next week when we discuss, we will talk about what is happening with stable coins, what is happening with AI, etc., etc. But right now, there are a couple of areas where there is investment potential, which your mainstream is not going to look at. One is environmental, and that is uh, definitely paying better than everything else. Second is investing into the future, that to specifically younger generation related. And the reason why I say that is your ability to draw a pension, your ability to have reasonable cost of living, indebtedness, shares, etc., depends on the younger generation. And it is in your best interest to invest in the future of the younger generation. So these two factors mean that invest in companies that are sustainable and are focused on the younger generation. They're fair and true to the younger generation. Those are the companies that are likely to generate a fantastic return on your investment. I'll stop here. Happy to answer any questions. This chat stream will be open, and on top of it, we will post the recording of the session tomorrow morning. So you will receive a copy of the recording as well as the summary in terms of what we have gone through today. Thank you. Thanks for watching.